Hello, I'm Haider Malik, host of the Memi Financial Group podcast. Today's topic is fueling restaurant growth, working capital loans in Toronto. Whether you're opening a new concept in King West, expanding patio service in Leslieville, or scaling your dark kitchen footprint across the GTA, reliable working capital keeps your operation cooking, even when rent, payroll, and supply bills all hit at once. Here's how to structure and manage working capital loans tailored to Toronto's restaurant scene. 1. Why working capital loans? Bridge timing gaps. Cover vendor invoices, food purveyors, linen services, equipment leases, when POS receipts or franchise royalties lag. Preserve term facilities. Keep your long-term equipment leases and mortgages intact. Use dedicated short-term loans for unpredictable operating costs. Match your cycle. Toronto dining demand often surges on weekends and around events. Short-term loans, 6 to 18 months, let you ramp up staffing and inventory without long amortizations. Mount 2. Loan options to consider. Unsecured term loans. Term and amount. 6 to 12 months, 25 to 50% of last year's revenue. Rates. Prime plus 2 to 4% depending on credit and cash flow history. Use case. Fund soft openings, new menu rollouts, or leasehold improvements. Receivables, secured loans. Structure. Advance up to 80% of credit card and corporate account receivables. Benefit. Draw as you ring up sales, interest only on used balances. Use case. When you service corporate catering or loyalty program billing. Inventory or equipment lines. Structure. Revolving facility against stored inventory, beer kegs, packaged goods, or existing kitchen gear. Advance rates, 50 to 70% of market value. Use case. Stock seasonal ingredients or finance small equipment upgrades mid-season. 3. Finding the right lender. 1. Local banks and credit unions. Institutions like Meridian or Alterna often understand Toronto hospitality cycles and offer relationship pricing. 2. Specialty hospitality financiers. Non-bank lenders who gauge your potential via location, average check size, and online ordering volumes. 3. Government-backed programs. The Canada Small Business Financing Program supports working capital loans up to $1 million, sharing lender risk and softening rates. 4. Key terms to negotiate. Interest-only draws. Pay just interest during peak expansion months, e.g., patio season, and amortize principal after summer revenues hit. Prepayment flexibility. No penalty lump sum repayments when business is booming, say after a busy holiday dinner service. May. Covenant light. Aim for minimal financial covenants. Avoid fixed coverage ratios if your monthly revenues swing by 30% between winter and summer. Renewal options. Secure the right to extend or top up your facility without full re-underwriting if you add a ghost kitchen or second location. 5. Managing your facility. 1. Strategic drawdowns. Time borrowing just before major payables, bulk produce deliveries or utility bills to minimize average daily balance. 2. Rapid repayment. Funnel weekend and special event takings into principal reduction to restore capacity for midweek marketing pushes. 3. Monitor KPIs. Track days, payable outstanding, DPO, and days sales outstanding, or DSO. Strive to keep DPO at least 5 days beyond DSO to maintain a positive cash cycle. 4. Communication. Keep your lender apprised of new revenue streams, online delivery partnerships, or branded merchandise sales to speed future funding. 3 action steps. 1. Audit your needs. Map your next 6 months of outflows, payroll, rent, vendor contracts, and align them with expected POS and catering revenues. 2. Gather proposals. Request term sheets from 2 banks, 1 credit union, and a specialty hospitality lender. Compare all-in rates, fees, and draw speeds. 3. Stress test scenarios. Simulate a 20% dip in dine-in traffic or a sudden bulk order opportunity. Confirm your chosen facility covers worst-case gaps without covenant breaches. By combining unsecured loans, receivables facilities, inventory or equipment lines, and government programs, and by managing draws and repayments proactively, you'll secure the working capital to fuel your restaurant's growth across Toronto's dynamic food scene. I'm Haider Malik. Thanks for listening.